welcome to another episode of FMD's Ask an Advisor series. Today I'm joined by Jason Calleja, Senior Financial Advisor at FMD Financial, and we're going to talk a little bit about attempting to time the market.
With timing the market, one, it's very difficult to do, but also the other challenge is it's not just one decision you need to make about when to exit the market, it's that second decision about when to go back in, and that's actually the harder one to do. So what we find is a better investment principle to follow is actually time in the market. So what that means is being patient, having that long-term time frame, and actually riding out that volatility along the way, and being patient and waiting for those returns to compound over time.
So what do you think tempts people to try and time the market?
It's a good question. I think it's natural human psychology. We all want to, once our investments have grown, protect those investments and not have any loss there. But the reality is, by doing that, you are taking a risk, as I touched on earlier, to try and get back in. So I think it's that psychology side of things. But ultimately, you are better off being patient and riding out that volatility, because even the best investors out there, the ones that are looking at it day on day, they struggle to be able to factor in all the different things that are happening in the market. You look in the current environment, you wake up every morning and there's a new story about whether it's tariffs or geopolitical events. Very difficult to know what's going to happen the next day.
Yeah, and there's some evidence, isn't there, that trying to time the market actually leads to worse outcomes.
Yeah, there's a lot of evidence out there. So there's been quite a few research papers put together. So one that I've recently seen is a Lonsec paper. So they looked at the ASX 300 over the last 20 years. And effectively what they found is if you stayed invested for the full 20 years, you had a return of about 9% per annum. If you just miss those top 10 days over the last 20 years, you effectively miss out on a third. So your return's about 6% per annum.
Wow.
You miss the top 20 days, returns about reduces by about 2/3, so you're down to about 4% per annum. So it's a pretty big impact just missing those amount of days can have.
And you're not quite sure when those days are going to occur.
I was going to say, if you knew when those days were going to occur, it'd be a lot easier and you could make some good money, but very, very difficult to do.
Yeah. So Jason, if we're not trying to time the market, what are we focused on when managing our clients' money?
So the starting point is we want to understand our clients' goals and what their investment time horizons are, because that's really an important driver of how we're going to invest their funds. The next point is building a diversified portfolio to withstand the volatility of the markets over time, because that's a natural part of the investment cycle. It's going to happen. And then there's other strategies that we can look at, like a dollar cost averaging strategy, which is with clients with new money. So not investing that all overnight, effectively taking a gradual approach to investing that and smoothing your entry into the market.
Yeah.
We also have, from an ongoing perspective, the FMD Investment Committee constantly meeting with economists, fund managers, research partners to understand what's happening in the economy, and they adjust the portfolios over time to reflect that.
Yeah, so there's constant monitoring of the portfolios, even if it maybe on the surface doesn't look like there's a lot of change happening from day to day. Yeah. Yeah, great. All right, well, thanks very much for joining us for Ask an Advisor, and we'll see you next time.
Thank you.